All right, I think we can get started. So I'm just gonna riff a little bit about Costco's moat. So I'm just gonna start kind of filling in the videos for these remaining modules that I still got to do. So we can talk about today answering the question: can the business defend itself against competitors for Costco? So there's lots of resources here for you to go through, and obviously, you're not limited to just this. But I thought this would be kind of a good place to get started. So when we talk about evaluating a company's competitive advantage, it's a subjective thing, right? Like I mentioned in the email, it's more of an art than a science, and smart people disagree, right? But like one kind of quick and dirty way to just see if there was some kind of competitive advantage in the past, doesn't mean that it'll continue for the next 10 years. Fastest way you can do it is just to kind of go and see some key financial metrics, right? So you can go into the financials here on ticker.com, you can go into ratios, and you can look at the return on capital, right? And the return on equity. And, these are very good returns, right? Generally, I don't really want to get into the idea of cost of capital, but let's just say anything above 15 is like anything above 10 is like an okay business. 10 to 15 is okay. Anything above like 15 is like a pretty good business, and then anything below 10 is like maybe not such a great business. And there's lots of different ways that we can calculate this. Whether we want to include like if we want to just do like return on tangible assets, or return on total invested capital. There's lots of different ways to kind of get at that, and we can address those kind of corner cases if anyone has those questions. But I mean, we can see like just looking at these numbers, Costco looks like a pretty good business, right? Consistent like 20% return on capital. And another thing is, I think it was in the materials in the previous modules, but Costco spends like $0 on advertising, and they have like $20 billion in sales, right? That's pretty powerful, right? Like, there's lots of questions that you can answer to get at this, and it's like very helpful to go through these. But to kind of simplify this, really, right? Like, the question you're trying to answer is like, can someone else replicate this business, or can someone else offer more value for a lower price to Costco's customers, and can they do it at scale, right? So is this like, but remember, that doesn't have to be like someone copycats Costco. Someone could come up with like a totally new way for people to buy stuff, right? Like Amazon, right? Like, for example. But and value doesn't only mean price, it also means convenience, right? It can also mean selection, right? So, it's a very difficult question to answer, and you kind of just have to go and like kind of read and just kind of swim around in some of this information, and then kind of see what sticks, right? To kind of answer this question, like, is this business replicable? Like, is there going to be another business that can provide more value, right? But right now, I mean, the way things are, it looks like Costco has, a pretty good position, right? Like historically and now, we'll figure out obviously it's a much more difficult question to answer what it's going to look like in 5, 10, 15 years. But for now, I mean, to be able to spend $0 on marketing, and put up like over $200 billion of sales, that's not easy to replicate, and that's a huge understatement. I think Walmart has more revenue, and they have to than Costco does, but they spend like over $10 billion on marketing, and as a percentage of the earnings that the business generates, it's actually a pretty sizable percentage, right? So to not have to spend that money on marketing, they can pass that on to customers and just keep lowering unit prices, right? So that's kind of one meta thing I wanted to mention, right? Is we're looking for like stuff that's difficult or impossible to replicate, like business models, right? But to really drive the point home, it's like, well, another way to kind of look at it is we're trying to ask the question. Here we'll change this central question here. Will there be another business that can provide Costco's customers more value for a lower price, right? And value, can mean price, convenience. I'm going to butcher the spelling of convenience. Convenience. Oh, geez. Google. Connivance. No, that's not what I meant. There we go. Not convenience. Convenience. Okay. And, an example of convenience would be Amazon, right? Like, when you go to Costco, you have to spend half a day there, driving there. You have to like go around. It's like this maze. And so if you're willing to pay up for it depends kind of what you value your time at. I'm not saying everyone on the planet has spreadsheets calculating what they value their time at, and then doing all this math to figure out does it make sense to go to Costco. But it's generally going to be like people that have the money to not go, and they would prefer to do something else on their weekends, right? Particularly if families where the parents are working all week, and you finally get to the weekend, and then do they enjoy going to Costco? Is that like a family thing they do together, or would they rather just order stuff on Amazon or some kind of delivery service, which I believe Costco also offers delivery service, and just do something else with their time, like go on a hike or something, or watch a movie or something, right? So convenience. So value isn't just about price; it's also convenience, and then you can also say selection, right? The thing with Costco is they don't have a great selection. It's only 3,700 SKUs, and then Walmart is significantly more than that, right? So for people that like selection, maybe they would prefer to go to Costco, right? And maybe another aspect of convenience is maybe if you live in a tiny apartment, maybe you don't want to buy 1 year's worth of toilet paper, right? So there's this other aspect of okay, this might only make sense for families and not individuals, right? And so there's multiple aspects to this central question, right? So one aspect is, will there be another business, right? And you have to look at Costco's customers, right? So even if there is another business that can do all these things, but it's not for Costco's customers, it's not really relevant, right? And then they can provide more value, right? These three things for a lower price, right? And so going back to this kind of second meta point, you form a working hypothesis, and then you want to look for disconfirming evidence. And this is, man, it's easier said than done. I've been doing this for many years now, and I often will find myself doing the opposite, looking for confirming evidence instead of disconfirming evidence, right? Particularly if if it's a stock that you own, or I don't know, if you work for a fund or something, and then there's office politics involved with the names, cognitive biases can really seep into this process, and you have to be really careful. And I make that mistake all the time. But ideally, you start from a working hypothesis, right? So you look at the return on capital for Costco. They spend $0 on marketing, $200 billion of revenue. You read these write-ups, and it seems like Costco's a good business. So maybe your hypothesis is Costco is a defensible business that will continue earning 20% plus return on invested capital for the next 10 years, right? That might be your working hypothesis. And then you want to go find disconfirming evidence, right? So, you want to go look for instances where businesses are starting to erode away Costco's profit pools, right? You want to look for examples where companies are entering markets where Costco is, whether that's geographical market or, in terms of like product space, but offering it online and starting to take share from Costco, right? Um, uh, the other aspect of this is, will there be another business? I would say there's actually another central question I would ask, which is, will there be demand for Costco's services in 10 years, right? Like you might have like a great defensible business model, but if the product or service that you provide is no longer wanted, the business is kind of screwed, right? So, I mean, in terms of groceries, I think we're generally pretty safe that, that consumers will continue to want, basic necessities. I mean, you could argue if you're like if you have a high conviction that, we're all going to be living in the metaverse or something, and we're all going to get like our food and nutrition in like totally different ways, and like the nature of like the household and all these things are going to change, then maybe, you would come to a different conclusion, right? But it's about just being internally consistent and collecting and looking for disconfirming evidence. And you have something interesting when on the journey for looking for disconfirming evidence, all you can find is more and more and more confirming evidence to the hypothesis, right? So that's kind of another meta point I would make. Another one is to think probabilistically, right? That's just the nature of the world we live in. It's not binary. It's not that like Costco has a 10 out of 10 moat or it has a 0 out of 10 moat. It's a range, right? Maybe there's a 20% likelihood that Costco's earnings will be down 40% in 10 years or something. Maybe there's a 50% chance that Costco's earnings will, double over the next 10 years. Something like that, right? That's kind of the framework I would use to think. Like you're collecting all this evidence, and then you kind of draw out a probability tree, and you think about like, okay, what are the different outcomes that can happen? And we'll talk more about that in in the kind of in this module, right? Like what's the overall risk versus reward, right? It's never one thing or another. It's always a spectrum. And the thing is, like, you can be right for the wrong reasons, right? Like you might think that Costco has a really defensible business because of reasons A, B, and C. And then in 10 years, when you look back and you see that Costco has survived, it might not be for reasons A, B, and C. It might be for a reason D and E, right? And so it takes like, you have to be like very intellectually honest, as you kind of continue to do this over many years, to look back and see like, okay, this was my hypothesis, and then is that actually what played out, right? Because sometimes we can just get lucky, right? Or sometimes it can be flipped, right? Like we can get unlucky, right? We say that for reasons A, B, and C, this is a defensible business. And then, let's say you said that in 2018. And then, you're looking at a business that got really hit by COVID. Like, let's say you found like this, I don't know, like an airline or something that you thought was like a wonderful business. And then because of COVID, the business got like hit. That's an external factor that doesn't necessarily mean you were wrong about why the business is defensible, but that's how we kind of that's one of the things we want to control for in position sizing, right? Like later on, when we kind of judge the overall risk versus reward, and kind of look at like the cyclicality of the business. But anyway, the point here is to think probabilistically, right? Like no business survives forever. Like every business, competitive advantage is built, and they erode over time, right? So another way to think about it is like, look, like Costco is already pretty old, right? Like it's been around, since I believe the 70s or the 80s. And it might be like an overly simplistic way to look at it, because companies obviously can innovate and stuff, and that's not to say that just because a company is young, it's only like 3 years old, you say, okay, well, I mean, this company's got like another 50 years left, right? Like it's not, that's when kind of the comparison between humans and companies falls apart, where you can say confidently, a child that's like 3 years old is very likely, barring kind of health conditions, to live for many more years. But in business, there's no guarantee. Like a 3-year-old business could die at age 6 or age 7. It can get out competed. The opposite is it tends to be a little bit more true when companies are older, getting to the 30, 40, 50-year mark, that, okay, like, is this company going to continue to survive, right? Because unfortunately, like, as companies age, like, bureaucracy seeps in, and, like, so for example, right, like, if there was a way to deliver the same experience of Costco, except do it online and do it significantly cheaper, right? Now Costco's at a disadvantage, right? Because they have all these like warehouses, and what used to be kind of a competitive advantage can very quickly turn into a competitive disadvantage, right? There's a bloated cost structure, right? Like, if someone else finds like a cheaper way to do it, cheaper way to deliver, right? And that's the thing about retail, is like, it's constantly evolving, right? Like, there's always new retail concepts, right? Like, initially it was like the department stores and the variety stores, and then the big box, like the like Walmart, big box discounters, and then it's these warehouse clubs, and then now we're kind of in the era of e-commerce, right? What's next? I don't know. So retail, unfortunately, is one of those types of business models that you just have to continually watch. And another aspect of thinking probabilistically is, when you think about retail, there's a lot of fixed costs, right, in rent, and Costco isn't really financially leveraged, but they own their locations, right? But most retailers are, they rent their locations, and those are fixed costs, and they sign like 10, 15, 20-year leases, right? And so in retail, generally what you see is, like, when things work, they work really well for, a limited amount of time. And then when things crack, they crack like big time, right? You see what's happened in the retail landscape with Amazon, and all these retailers filing for bankruptcy over the last like 10 years, right? Like Sears, Kmart, like J. Crew, all these companies, right? So I just wanted to feed all of that into this idea of thinking probabilistically, right? Because depending on the business model that you're looking at, the problem, like, to ascribe different probabilities, you have to take these things into account, like how much financial leverage is there, how much operating leverage is there, how sensitive is the business to changes in the external environment, right? Yeah, okay. And then the last one this is kind of the most difficult one, and kind of where the rubber meets the road, is finding kind of creative ways to tease out metrics in your quest for disconfirming evidence, right? So I'll give you an example. I did the same analysis that this wonderful author of this Substack article did, but I don't really want to go and like find it, so I'm just going to show you his work, right? And again, like, we're being efficient with our research, right? Like, we're leveraging other people's work. So one of the things with Costco, this is just an example of what a metric, like one of these kind of creative metrics might look like. Okay. So one of the things with Costco is, if you watch the intro video to this module, I talked about economies of scale and like purchasing scale. Costco obviously has a lot of purchasing scale, right? Like, they're able to exert a lot of leverage over vendors, and get the lowest possible price, right? And they have their own warehouses, their own like infrastructure, and so they've like they're wringing out costs out of the system and just continually passing that on to customers, right? So this would be part of the working hypothesis, right? That, okay, Costco's a defensible business model that'll continue to earn 20% ROIC for the next 10 years. And okay, so it's like, why is it defensible? Well, one of the things might be like purchasing economies of scale, right? So then the disconfirming evidence would be, okay, it would be like if someone told you that actually Walmart consistently gets better prices on their products than Costco, that would be a piece of disconfirming evidence, right? So you go and you try to look for it, but we don't have access to expert networks, as retail investors, and so we have to be like, okay, well, like what do we have to work with? Like, what metrics could we possibly create to triangulate this, right? Because we're working in a world with limited information. We don't have perfect information. We have imperfect information, like highly imperfect information, right? Again, this is why we own multiple stocks, because we don't, we only get to see, we don't get to see behind the curtains as a public equity investor, right? Nor should we, right? Because that would, you start getting into trouble in terms of potentially breaking the law with insider trading, right? So what information do we have where we can kind of, evaluate purchasing scale, right? So, okay, so you gotta realize, like businesses are generally irrational actors, right? And generally, when it comes to purchasing scale, the bigger the company, the better prices they would get, right? Okay, but let's refine this even more, right? Because one of the things about Costco's business model is they have very limited SKUs, very, very limited selection, right? So that means within each product category, they're very deep, right? So when Costco goes to a vendor, they're like, we are going to buy a shitload of volume from you. You're going to earn very high profit dollars, but your margin is going to be low, right? And because they buy so much in each SKU, they can exert leverage and get the lowest unit prices, right? So, okay. So that information is available, right? So we can actually go through Costco, Sam's Club, BJ Wholesale Club, Walmart, and Target and so heated annual revenue. Actually, a better way to do it would be average COGS, cost of goods sold, divided by the number of SKUs, right? So obviously it's not perfect because Costco will sell different amounts within different SKUs, right? So again, imperfect information, right? So we're just generally getting an idea, right? So if you go in and you do this analysis, and you can pull up the filings for Costco. Sam's Club is part of the Walmart filings. You'll see that within each category, Costco buys significantly more, spends significantly more on inventory, right? So they should have way more scale, right? So okay, you continue to go down this so we, in our quest for disconfirming evidence, right? Like we're saying, okay, like if we're gonna try to kill this hypothesis, we think let's say Walmart does more revenue than Costco does, right? So maybe they have more leverage, right? But you do this math, you see okay, actually, Costco spends way more per product category, than Walmart or even Sam's Club, their closest direct competitor, right? And this is a very powerful piece of confirming evidence, right? The difference between, I'm not saying every single SKU they do is a $50 million order every year, because it's going to vary because they sell way more toilet paper than they sell helicopter seats or something. One of those weird things you get at Costco, right? So it's not perfect, right? Ideally you would break this up into every category, but we don't need to go through that kind of brain damage. So this is a highly validating piece of evidence that Costco has more purchasing scale than Sam's Club, BJ, Walmart, and Target, right? And now what you can do is, okay, does Costco have the lowest price? You can ask that question, right? And you can go and kind of look for pricing studies, right? And unfortunately, this process, it's just not going to be super efficient. You just have to keep going through different stuff, and then you're just digging through a haystack, and you're kind of hoping to come across a needle, right? That's just how the research process is. And unfortunately, if that's not something you want to do, it would be a great reason to index, right? So again, this has to be a game that you enjoy playing if you want to do this, right? So, in my kind of journey in doing this, I found a pretty interesting piece of little tidbit, right, with BJ's, right? So here we go, this thing. So BJ's claims that compared to this annual report on Form 10K includes estimates regarding market and industry data that we have prepared based on our market management knowledge and experience. Okay, yeah, this is what I was going for. We make reference to consistently offering 25% or more savings on a representative basket of manufacturer branded groceries compared to typical supermarket competitors. Right? So, they claim that BJ's claims they can save. I mean, BJ's is like a very similar business model to Costco, membership model, warehouse club, all these things, right? It's just smaller scale, right? And so they say, hey, we can save 25% versus, grocery chains, right? Versus typical supermarket competitors, right? So I think this would be like Kroger's and those guys. I don't think this would include kind of the Walmart and Target. I'm not really sure. Let's see. We identify the fours. Yeah, so let's see how they define supermarket competitors. Yeah, supermarket competitors do not include non-traditional sellers of groceries, such as drugstores, online sellers, supermarkets. Okay, so they're using like some really specific definition. So this wouldn't really include Walmart and those guys, but it does include, I think, a pretty significant share of the market for groceries. So BJ's is claiming that they sit kind of low on the cost curve, right? And then you kind of take that and you combine it with this, and you're like, well, Costco's got to be way cheaper than BJ, right? And then now again, you look for contradicting evidence, and you say, okay, well, have people done pricing surveys, right, on Costco, right? And you can go leverage like other people's research yet again, right? And it's a difficult thing to do, right? Because there's all sorts of biases in these research studies. First of all, you have to compare it to unit costs, not just like, obviously you're getting a lot more units at Costco. The other thing is you have to control for product quality, right? You can't just compare like two things of toilet paper. You have to also control for quality, right? So again, like these metrics, like they become complex, right? Because you have to design, like you have to be like a scientist. Like you have to go in and design a series of experiments, or you can link together other people's experiments that they've done and come to some kind of like rough conclusion for yourself, right? So the pricing survey one, that's a really complex one that you have to make sure that the numbers are kind of clean and free of biases, right? And the main one I see when I see people do these pricing surveys is they don't control for quality, right? So, so you can go in kind of like find like all these different things, and kind of the place I get to is that, and generally Costco, when controlled for quality, is, and I should probably add that to one of these things as well, price quality. Because Costco claims their product quality is just as good as like a branded competitor. Like they say that their like generic branded Grey Goose, like their Kirkland vodka is just as good as Grey Goose, right? And there's, if you go on like Reddit and all these things, you can see that generally this is like widely accepted by people that go and do these studies and surveys, that Costco does actually kind of offer the lowest unit prices for that product quality. Now the thing is, not everyone cares about product quality, right? Like, people are like, well, I'd rather just pay a lower price for lower quality, right? And so that's kind of like fair enough. So that was like kind of the four things I wanted to talk about. Okay, so then there's purchasing scale, and then there's marketing scale, right? That I would say Costco has, which is they're able to they have this like efficient machine that is able to generate $227 billion+ of sales and spend $0 on advertising, right? Because their customers like advertise for them, like they'll be on the news because of some ridiculously low price that they offer, or people like they've grown a lot through like word of mouth, right? So that means that their per unit costs are just lower, right? There's another aspect of this economies of scale, which is local scale, right? So, you have to kind of go in and do this math of, in like a local geography, kind of you look at one location of Costco and you look about and you try to kind of estimate how, like, what is the catchment area? Like, how far is this kind of circle of people that kind of come and shop at that Costco? And then what do those people in total kind of spend on their grocery bill, right? Every year, and then what share of that does that Costco location have, right? And then you can kind of get into this concept of like, okay, how much market share would a competitor need just to break even on their fixed costs to enter this market and compete with Costco? What kind of margin structure would that competitor need? Would that competitor be able to earn while still price matching and convenience and quality and selection matching Costco, right? And I think generally, like when you do that math, you get to a place where it's like, okay, well, it's very difficult to compete with Costco. I mean, I wouldn't have time in this video. Maybe I can, if there's interest, I can try to do this in a separate video, trying to do this analysis. But basically, you have to kind of combine like the numbers and the story, right? To go in and kind of validate these things of like, okay, like another question you can ask, like another thought experiment really that you can do, maybe I'll add that kind of to this meta point, right? Is run thought experiments and and like leverage other people's analysis and experience. But in terms of like a thought experiment, it would be something like, okay, if I wanted to go compete with Costco, like if someone gave me like $100 billion to go and compete with Costco, how would I do it? Right? Could I do it? Could I go and like replicate that business or create a whole new business that would offer more convenience for a lower price? Right? It's a really tricky one to answer, but actually through that process, you also kind of build those muscles of entrepreneurship, right? Of like creating business ideas. And this is kind of one of those ways where, yeah, like you're looking at stocks, but this can actually spark an idea to start your own company, right? Because like, again, like all you're doing at the end of the day is answering those 6 same questions, right? So if someone gave you like $100 billion, like how would you go compete with Costco, right? Like, so you go, like, is there like like in 10 years, can Amazon offer like lower prices, like better convenience, like all these things, right? Like, so then you have to kind of go and think about like the warehouse operations of Amazon and like what does that cost structure and setup look like? And this information, it's not going to be spoon fed to you, right? Like, again, you have to go and like attend industry events, like talk to people, read like research reports, and you can kind of like triangulate roughly, right? And sometimes it's just too hard. Like sometimes it's like, all right, this is in the too hard pile for me. I'm not going to be able to like figure this out, and that's okay. Costco is a fairly simple one to understand, and it's generally like widely accepted that it's like a great business. I think that kind of the key question with Costco is, is online going to offer like, could online, you have to kind of do the unit economics, like the math, and say like, okay, can online offer a lower price and like, lower price, better quality, better convenience, better selection. I personally, I haven't like done that work to figure that out and to kind of sit in front of you and say like, this is what I found. But that's kind of the path that you would have to take, right? To figure these things out. what I really wanted to do here is to kind of give you some direction in terms of how to like go and investigate these questions, right? Because that's the thing that I was never taught in school, and it was like very difficult to learn it on my own. I kind of had to go work for a fund, and and my PM had to do the exact same thing, right? Like it's like a lineage, right? Like my PM learned from his previous PM, right? And then I learned from him, and then so I just wanted to give you kind of a higher, hopefully a higher, actually, hopefully your standard of excellence is even higher than mine. That would be even better. But I just wanted to give you kind of a standard of excellence in terms of what it takes to answer that question. Is this company going to be around and thriving in 10 years? It's a very difficult question to answer. Like you have to be like a scientist and go out and do your own experiments and analyses and like piece like different things together, like almost like a scientist slash a detective, really. And that's what makes, to me, investing fascinating, but it's also very difficult. Like if you're in this just to make money, like this is not going to be fun for you at all. Like unless you enjoy this process, it's excruciating. It can be, right? Because like you're reading all this nonfiction, like you have to have the curiosity to like do all these different things, right? But what's cool about it is like you become a better thinker when you do these things, and it kind of bleeds into other aspects of your life, right? Like when you're, I don't know, like making a decision on a political candidate or something, like you can actually do like good research, like better research, right? Like you can actually go look for disconfirming evidence on what the politician is saying or their views and stuff, right? Like ultimately the skill we have to cultivate as investors is, I mean, we have to have the curiosity or otherwise it's just never going to work. But the skill is kind of research. Research is the skill to have here. And that's why, Peter Lynch says, know what you own. And, there's a lot of businesses that you own that that you're familiar with, where you're familiar with the product, right? Costco is a great example, right? Like you don't have to, like if you were looking at like a dental supplier, dental equipment supplier or something, like you have to go learn like a lot about the nature of that business, right? Like unless you're already involved in it. With Costco, it's like you touch the business, on a fairly regular basis. Like I think they have like over 100 plus million members, right? So, and a lot of people are familiar with the business or they can conceptualize it very easily, right? So if you kind of stick to those kinds of businesses, this research process is a lot easier, right? And then when you go to Costco, it's kind of like a more enriching process because like you're also kind of doing like some of your own little research, right? The thing I would be careful about is extrapolating too much from like little points of data, right? Like if you find like one day, like one weekend, you find the toilet paper at Sam's Club is cheaper and you're like, oh my God, like Costco's no longer the low cost player, right? You have to do that across like 100 different products and you have to do it over like the course of like months, if not like years, right? Because sometimes competitors will like drastically lower their price temporarily just to attract customers and then they'll jack up the price. Or competitors will lower the price in one area and then they'll hike prices in another area, right? So there's just so much noise when you try to go and collect data during this research process that it's really hard. Like there's a lot of biases in the data and you have to do a lot of like kind of cleanup work, right? Like for example, like this thing, even this could be skewed, right? Like if Costco gets like 80% of its revenue from, like a handful of product categories where it has, scale, but then in those same categories, let me like rephrase. Let's say in a world where Costco and Sam's Club and BJ, like if they earn different levels of profitability with different products and the products where they earn the highest level of profitability, they have the same amount of purchasing scale, then like this is no longer like as validating to the hypothesis, right? So it's just like you constantly have to be asking these questions of like, okay, like is the data clean? Like what might be biases in the data? Like how would I correct for that? And so it's kind of like this ongoing process, right? Like it's never finished. There's always like next steps. There's always things that you're like curious about that are on your mind as an investor. But yeah, that's all I really wanted to talk about during this Q&A. So I'll just post this in the Costco section, and yeah, I'll see you guys next week. Have a wonderful weekend.